Well, welcome everybody. I want you to join me in welcoming today's speaker for the New Ideas in Insurance series. We have with us Robert Schindler, who comes to us from Rutgers Business School. He is a psychologist by training, and he's done a lot of work on stuff that doesn't have anything to do with insurance, like spirituality and consumer behavior and anxiety and consumer behavior. And that sort of does have to do with insurance, he's going to argue. Um, he's joined somewhere in the background, I don't see his face on the screen, by his co-author, Matt Isaac from Seattle University Business School, and he's a co-author on the paper that Rob's going to be talking about. But Rob tells me that he's not going to just talk about the paper that some of you may have read, but also the larger set of ideas that it's embedded in and sort of where the research is leading. I don't want to spoil anything, but it turns out that people seem to value insurance not for the classic economic, risk spreading and all that stuff. They think that it has kind of quasi-magical properties, or at least that's what our speaker is going to argue. And so join me for a fascinating discussion. And I just want to say thanks, Rob, for coming. Let me just quickly add two things. If you have questions, you can either send them to me in the chat, or you can raise your hand using the WebEx raise hand function, and I'll try to see if I can find you, but the chat maybe work a little bit better. 2 weeks from now, our speaker is going to be Allison Hoffman from UPenn talking about redesigning health insurance. So with that, Rob, the stage is yours. Thank you so much for coming.
Thank you. Thank you so much for inviting me. It's great to be here this afternoon. Let me start then with our the topic is the consumers other than rational motives for buying insurance. And so to talk about other than rational motives, we need to know what the rational motive is. And in my view, the rational motive, the core concept of insurance, is protection against catastrophic financial loss. That is, paying periodic small amounts, which you can afford, to avoid the possibility of paying a large amount which you cannot afford. Like, for example, destruction of one's home by fire. That would be catastrophic. For most people, their home is a very, very large part of their, very large amount of money for them. It would totally disturb their lifestyle and the family's lifestyle if they were not able to replace their house after a catastrophic fire. So it's a needed, certainly, in the core concept of insurance, it's a needed thing. It's rational for the buyer to have fire insurance for one's home and things like that. And it's also, of course, insurance is very profitable for the seller. It's very rational for the seller because, typically property and casualty insurance has loss ratios of like 60%. And by loss ratio here, I mean the what they would call the pure direct loss ratio, which means that 60% of the premium dollar is what lands in the payments, claim payments of the buyers, of the insurance buyers. So that's like a measure of the industry's gross profit on the insurance product. And I think it's an important number to keep in mind. All right, so if that's the core concept of insurance, then we can sort of take a look at why there's a lot of insurance, or review the idea that there's a lot of insurance that covers non-catastrophic losses. If catastrophic loss is the important part of insurance, what about all the insurance for non-catastrophic losses, like life insurance for children and pets? I mean, if you lose a child, it certainly could be catastrophic, but in terms of the finances, there's not a catastrophic financial loss there. Low deductible levels in homeowners and automobile insurance. Again, those the low deductible levels are if you have a $500 deductible level, you're paying something to protect yourself against losses between $500 and $1,000, things like that. Those are not catastrophic. You don't need that. Or insurance covering the cost to repair a water or sewage pipe, or insurance to fix or replace a broken appliance or electronics product. These are around all the time, these extended warranties, things to, insurance products to fix or repair a broken appliance, or a car. These are all around, heavily promoted because they're very profitable. extended warranties? How many people have bought something and you just get hounded by afterwards by advertising, asking if you might be interested in extending your warranty or something like that? And it's a tremendously large business. It's an insurance product that's tremendously big. Here we see they estimate that, within 10 years, it'll be $274 billion globally. This article says now it's about a little less than half that, but it's still over $100 billion of extended warranties. That's the size of this industry. It is a tremendously large business. It's a big product. So the question is, given that there's widespread interest in insuring non-catastrophic losses, it suggests the involvement of motives other than the rational motives for insurance, the core motive for insurance. And the suggestion that I think is important is that it seems that insurance can be a means of managing fear. There was some famous experiments by Eric Johnson and his colleagues in the 90s where they found that respondents were more willing to pay more for flight insurance that covered losses from terrorist acts than for flight insurance that covered losses from all possible causes. In other words, just the mentioning of terrorist acts made people sort of really want that insurance. And it suggested that having insurance was a means of managing fear. So that led us to our first other than rational motive, and that is that there we go. That insurance may give consumers the sense that the negative event is less likely to occur, as if insurance acts as a talisman that can magically keep away the bad event. All right. Does insurance give the sense that's less likely to occur? Why could that? How could that ever happen? Well, possibly, we have to look at some of the research that's been done on how we judge the likelihood that an event occurs. We tend to judge the frequency of an event by the ease with which instances of the event come to mind. That has been pioneered. That research has been pioneered by Amos Tversky and Danny Kahneman and called the availability heuristic. Right. And it comes to mind a lot when we think about how likely it is to come. We think it's more likely to come. Well, anxiety about an event increases repetitive thoughts about the event. And there's a long literature in psychology that that's the case. When something upsetting happens, you think about it repeatedly. Well, that leads to this, at the end of Tversky and Kahneman's paper on the availability heuristic, they say perhaps the most obvious demonstration of availability in real life is the impact of the fortuitous availability of incidents or scenarios. Many readers must have experienced the temporary rise in the subjective probability of an accident after seeing a car overturned by the side of the road. Continued preoccupation with an outcome may increase its availability and hence its perceived likelihood. So, if insurance can, it's reassuring. If insurance, gives you some protection, some financial protection. But if it reduces your anxiety about the negative event, it could reduce the perceived likelihood of the negative event. So this was first researched with a clever technique, which could be called the insurance reminder technique, by Ori Tykaczynski about 15 years ago. In this technique, you estimate the probability that you would need some kind of medical procedure, a serious operation or something like that, and then write the name of your health insurance plan afterwards, okay? And what she did was she varied the order of the two questions. In one condition, you first estimated the probability that you need the operation, and the second condition, the first question, was the name of your health insurance plan. And what she found was the people who first named their health insurance plan estimated a lower probability that they'd need an operation than the people who first estimated the probability that they need an operation and then named their health insurance plan. It's very clever design. However, they had some trouble. There's been some difficulty replicating that technique. So we decided to use something that's more experimental. We varied insurance between respondents. And we had a scenario of a situation with a potential mishap. And we varied between respondents the presence of insurance and measured the perceived likelihood of the mishap occurring. So it's not as elegant as Tykaczynski's method, but I think it gives us a more replicable result. Okay. So we're going to report here 4 studies that are in the paper that we published this spring. And the first study, the potential mishap was the loss or damage during the rental of a treasured item. And the insurance condition was the words 100% worry-free guarantee policy for for the rental of this treasured item that someone's not going to hurt that. And the no insurance condition, insurance wasn't even mentioned. You just feel you're taking a risk there. And the perceived likelihood that this treasured item would be lost or damaged was lower in the insurance condition, 3.56, than in the control condition, 3.92. In other words, it lowered the perceived likelihood, to a statistically significant degree, lowered the perceived likelihood of that negative event. So that showed us that we're going to be able to get the effect with this experimental technique. So we did another one now looking at more like a standard insurance situation. Here, the potential mishap was a loss or damage during the shipment of a treasured item. You're shipping it to a place where, it could get damaged. And so we had the insurance coverage by a real insurance company, one that has very high ratings, Chubb Insurance, right? And so we gave them a little picture showing how, we want to evoke the feeling of trust and reassurance here. So, we can lower their thoughts about the worries about the product, about the product being hurt or lost or damaged. And so we showed them, in one condition, the insurance condition, we said it's going to be, protect your treasured possession is protected by full coverage from Chubb Insurance, which has an industry-leading level of customer satisfaction. We showed these pictures to be reassuring about it. And in the control condition, no insurance condition, nothing, no mention of insurance, no showing the pictures that were reassuring. And we then asked them the perceived likelihood of loss or damage. And again, we found that in the control condition, and the 7-point scale is 3.08, it was lower. The perceived likelihood of loss and damage was lower in the insurance condition. And we also asked them about how anxious they were about the thing being hurt, being lost or damaged. And so we had reported anxiety as a mediating variable, and a mediation test showed that it was a significant mediator of the effect. In other words, when you statistically control for the level of anxiety, the effect then would go away. All right. A third study then was to see if we can make this go away by having an insurance company that's not so reassuring. Okay, so we still had the loss or damage during the shipment of a treasured item, but now we had 3 conditions. One, a control condition with no insurance, and one is a condition with not reassuring insurance. Okay, this was not very reassuring insurance, right? This was Shield, a made-up name, Shield Insurance, but it wasn't very reassuring. It didn't have good reviews, wasn't well thought of at all. And in the other condition, the third condition, we had our same name, but we said, oh, this is a great, you might not have heard about it, but it's a really great insurer. Look at all the great ratings it's had. Okay, so we had an insurance condition that was not reassuring and one that was. And what we found was that there was no benefit in the perceived likelihood. There was no lowering of the perceived likelihood of loss and damage from the poor review insurance, but there was from the good review insurance. And again, reported anxiety was a significant mediator of the effect. In other words, the good review insurance, the Shield Insurance, when it was rated A+ and so on, was lowered the perceived likelihood that the product would be, the treasured item would be lost or damaged. And it was mediated by anxiety. It lowered their anxiety. And when you controlled statistically for anxiety, then that effect of the insurance on the perceived likelihood of loss and damage would go away. All right. So our fourth study, we wanted to get a little bit more direct evidence that anxiety and thoughts about loss and damage were involved there. So we had a similar scenario and insurance condition to similar to study 2. And we also measured anxiety, as we did before, and also degree of experiencing negative thoughts about the loss or damage of the treasured item. And what we found was that indeed, we had insurance that was reassuring. It was A-rated and all that. It lowered the reported anxiety. it lowered the reported thoughts of loss or damage, and it lowered the perceived likelihood of loss and damage. And we found through mediation analysis that anxiety and these thoughts were significant mediators of the effect of the insurance on lowering the likelihood of that the treasured item would be lost or damaged. So again, we have some
Rob, can I
good
just ask
evidence.
you, just
Yeah,
really quickly, what's the difference
sure.
between thoughts of loss and damage and reported anxiety? Aren't those, I'm not sure I see the distinction between those concepts.
Anxiety is how you're feeling. Thoughts are number of times you're thinking about this. It's not asking about feelings, it's asking about thoughts. How many times are you thinking about it? And Matt, I know you're here. If you want to chime in, please do. Anytime during the discussion. Is he able to, Peter?
Yeah, I think he can turn on his microphone and
Okay.
talk, as far as I know.
I'm here, Robert. Yeah, I think it's exactly right. We do expect them to be correlated, but one is trying to tap into kind of cognition. So really, we were asking about the specific number of thoughts, the number of times they had these thoughts related to loss or damage. In the other case, we were just asking about feelings of anxiety and to report their feelings. So they are correlated, and we do find some similarities, but we wanted to understand the cognitive aspect separate from kind of this kind of affective reflection.
Got it. Okay, thanks.
Okay. All right. So we have then some, good evidence that there's an aspect of insurance that acts as a talisman, acts as in people's minds, wards off to some extent, wards off the sense that the bad event will occur. Well, what are some implications of that? Well, one is, maybe insurance companies should be careful about their product names and promotional wording. Like there's a Canadian company that has a product called Cancer Guard. They'll give you a financial amount. They'll give you a financial. You may have a financial claim if you show that you've gotten cancer and you're going to need all that medical care. But Cancer Guard, it's a kind of a name that seems to be playing on people's feelings that maybe insurance can protect them against something bad. And even you're in good hands, the well thought of slogan for Allstate, is questionable. Yeah, you're in good hands that they'll make it right money wise. But if you read about how they got that phrase, the advertising person who was involved said that he got the idea of it when his daughter was in the hospital, and he was worried about how she would be, and the nurses there said, "Oh, we've got a really good doctor on this case. She's in good. You're in good hands." In other words, to a large extent, it means things are going to be okay. You're not going to have anything bad happening to you. And I think it's questionable whether insurance companies should do this and should be allowed to have names and promotional slogans that might exacerbate our tendencies to think of insurance as a talisman, because that's going to lead people to buy it when they really wouldn't really need it. So there should be some tighter regulatory oversight of these ways of talking about insurance. And of course, more consumer education, more emphasis that insurance is a purely financial product. It's not going to protect you against anything, any bad event occurring, only reimburse you if that bad effect occurs. All right. The second of our not other than rational motives for buying insurance is actually, as amazing as it is that people will think insurance will lower the likelihood of the event, I think our second other than rational motive is even more amazing, is even more strange, right? And that is that another other than rational motive is that consumers may feel that they will actually make money from buying insurance. Now that, when you think about it, given the 60% gross margin that insurance has, very profitable product for the seller, how can people think they'll actually make money on buying insurance? Well, this is not, this is not new that we've been thinking about. This has been around, and Peter has written about it, calling it the mistaken calculator hypothesis. That people are going to overestimate the amount that they would actually have to pay if they didn't have the insurance, and so they look at it, and if the insurance is less than that, they say, I'm going to make out. I'm going to win if I buy that insurance. Okay. So the question is, does that really exist? Is that a widespread phenomenon? And if so, what could be motivating the calculators to be so mistaken? All right, so we've finished at this point 2 studies regarding this. One is we used a washing machine product where the price was $800, and they were offering the seller was offering a $200 a 3-year extended warranty on the purchase. And the salesperson said the extended warranty covers any type of mechanical problem. It will pay for all parts and labor necessary for repair of this $800 washing machine. That's the low salience version. The high salience version, we added a little story. The salesperson goes on to say, one customer of ours found that the washing machine started making too much noise. He simply called the extended warranty repair number, and they sent the technician, no cost. And so that we had 2 conditions, one with just the first paragraph here and the other with both paragraphs. And we simply asked people, would they purchase this extended warranty for $200? And then we asked them how much, whether or not you purchased the warranty, how much you think you'd have to pay for parts and labor for repairs of this washing machine during the next 3 years. And it had a sliding scale that was between 0 and 1,600. Okay. And what we found was that about 1/3 of the people would purchase the warranty. This was an M-Turk sample, but very large sample. And we found about 1/3 of the people would purchase the warranty. But the salience didn't seem to matter much, really. There wasn't a statistically significant difference between that giving the example of the problem and just saying it. But about 1/3 of the people purchased a warranty, which is in the ballpark of real likelihood, real sales of extended warranties. It's in that ballpark. And of course, if you look at the people who purchased the warranty, this is in the dark shading here, most of them, like 88% of them, would pay $200 for the extended warranty, believed that the losses that they would have incurred would be more than $200. So therefore, they're making money by buying the extended warranty for $200 because they would have had losses for over $200. So most of the people who buy the extended warranty, it seems like they think they're going to make out, going to win. All right, well, how come then there's so many mistaken calculators? Well, it reminds us of this idea that maybe has something to do with gambling. It's sort of like a gamble you're taking here, the extended warranty. They're throwing out a gauntlet. Do you want this? Do you think you're going to win here? And research on gambling has been very, very interesting. It suggests that those who enjoy gambling tend to experience winning as a sign of personal self-efficacy, that it's because of them. It's because of their abilities that lead them to win in gambling. And that's what drives the interest in gambling, which of course is very widespread. And so in one of the papers on this, Michael Wohl and his colleagues wrote this. They suggested that, from their gambling research, suggested the interventions to seek to prevent, treat problematic wagering in early stage gamblers might be useful to affect the extent to which we can modify these young people's belief that they are charmed by high levels of dispositional luck. And I love that use of the word charm, because it's sort of like it's like, talisman is a magical thing. Well, I think the feeling that people have about winning, it's my lucky day. I really know how to do this. It's in a way, it gives them, self-efficacy doesn't capture it. I think it charms them. It makes them feel like they are, that there's an aura about them. There's something special. There's something great about them. These are feelings that are things that we haven't really explored, and we don't understand very well, that feeling, the nature of our feelings about this kind of thing. It can make us feel charmed by winning, at least for someone who has an enjoyment of gambling. And so we in our study, of the washing machines, we had the gambling, we added a gambler's belief questionnaire, which was from, cited in the Michael Wall paper and so on. And we look at some of these items on the gambler's belief questionnaire, like gambling is more than just luck. My gambling wins are evidence that I have skill and knowledge related to gambling. I have a lucky technique I use when I gamble. In the long run, I'll win more money than I'll lose gambling. Even though I might be losing with my gambling strategy or plan, I must maintain that strategy because I know eventually it'll come through for me. If I lose money gambling, I should try to win it back. I mean, you know, you can recognize some of these things. You've heard them, from problem gamblers. You've heard this kind of thing. All right, so we gave the gambling belief scale to all of the respondents to this washing machine extended warranty study. And what we found was that their score on the gambling belief questionnaire was positively correlated with their likelihood of buying the extended warranty. In other words, people who scored higher on the gambling belief questionnaire were more likely to purchase the extended warranty, purchase the insurance. And that this relationship between the gambling tendency and buying the warranty was mediated by their perception of the estimated cost of repairs. So they sort of, the gamblers sort of over, they were motivated to be an inaccurate estimator of the cost of repairs by the prospect that they could be felt to be charmed by the idea that they are lucky and can make good choices, good gambles. All right, so we did a second study to fix some problems in the first study. One of the problems is that we asked the question of would you purchase the warranty after we asked the question about estimating the costs after we asked them if they purchased the warranty, and we recognize we have to vary the order of the questions to make sure they're not interfering with each other. So that's the main difference in the second study from the first study. We systematically varied the order of these two questions, the cost of repairs and purchasing the warranty. And we also, again, administered the gambler's belief questionnaire, and we had a different product. Okay, and to get a different product, we sort of looked into the actual advertisements, and this is an actual advertisement from a Best Buy website, right, where they're selling a pair of headphones for $350, right, and they're selling a 2-year extended warranty on it for $90. That's more than a quarter of the price of the headphones, which is high to begin with, for an extended warranty. Okay, and they, I'm sure it's not there in their ad because no one buys it. I think a lot of people buy it. So we use that as our scenario, something, realistic. And so we asked, we rounded it off so they could do some mental arithmetic. $90 to purchase the 2-year warranty and we showed them the picture of the $350 headphones, and we asked them if they'd buy the warranty and what they estimated the cost of repairs was, and we systematically varied the order of these two questions. And we found here a smaller percentage of people purchased the warranty, maybe not surprising because that is a pretty hefty amount to be spending on headphones to begin with, but it was still around a quarter of the people would buy that extended warranty for $90 on the $350 headphones. And we found that the order of the questions did not matter. There was no statistically significant difference between their percentage of people would buy it, depending on the order of the questions. Didn't matter. All right, again, what we found is those who purchased the warranty, most of them, thought that their losses would be more than $90, that they thought they'd make out. Again, most of the people who buying the extended warranty thought they would make out. And again, the gambling beliefs questionnaire positively correlated with the likelihood of buying insurance, so that participants who scored higher on the gambling beliefs questionnaire, the gamblers, were more likely to purchase the insurance. And again, they had higher estimated the gamblers had higher estimated costs of repair, and that mediated their greater likelihood of purchasing the insurance. So it raises the question then, do extended warranties evoke gambling tendencies? You know, the tendency to gamble was positively correlated with choosing the extended warranty. So it raises the question, did the desire to win among those with gambling tendencies lead them to overestimate the likely loss, that they would have, likely need for repairs of the washing machine or of the headphones, so that they could experience the pleasure of winning? In other words, it raises the question, can the buying an extended warranty provide people with an opportunity to feel charmed, to feel like they won? And so that might motivate these people to overestimate the likelihood of winning, because if they do, they can win. They can beat the big businesses that offer these things. They can feel charmed. They can feel that they really do know what to buy, that it's not just luck. They know the choices to make, right? They could lead them to feel charmed. And if gambling itself leads them to do that, isn't the extended warranty offering them like another gamble? And we know that the tendency to gamble is big in people. The gambling industry is enormous, and gambling practice of gambling is and has always been in human societies a very large thing, and it's of course addictive and a serious behavioral health problem. All right, so that was our second other than rational motive, that people think they might actually make money from gambling. The third other than rational motive for buying insurance is more controversial than the talisman and the making money motives, but I thought we would mention it anyway. And that is, consumers may buy unneeded insurance out of fear of regret, embarrassment, or social pressure. Now, this is talked about again by Peter in his 2013 paper, and there has been quite a bit of research suggesting that there's some kind of emotional risk management involved, that you don't want to have to sort of, if you've offered insurance and you say no and then something bad happens, you sort of are embarrassed, or you feel regretful, or people make fun of you or something like that because, hey, you didn't buy the insurance, right? But so people might buy insurance for that. All right, possibly. It's hard to say for sure that that's other than rational. Who's to say if using insurance to manage such feelings is rational or not? Because those feelings might be very strong to those people, so it might be worth 40% of their insurance dollar to use insurance to manage a cost they could have incurred without pain, without financial pain. So it suggests, we like to suggest the avoiding regret motive as a possible other than rational motive for insurance, but it obviously needs further research. Like, what would consumers do if they had information on the costs involved in this means of managing their feelings? If they knew the loss ratio was 60%, that they're throwing away 40% of every dollar that they spend on it, is that worth managing? Is that worth it to avoid the embarrassment of having a loss that you could cover, but you wasn't insured? That's a topic of future research. So conclusions on this is, makes me think about the insurance product in general. I'm a consumer behavior researcher. We study all kinds of consumer products, and of them, insurance is a unique and powerful product. It's like no other of the products that we study. And for most people, buying at least some insurance is essential for financial health. It's a good product. It makes sense. It's a good thing to have around. Further, the protective power of insurance has not been fully realized. And I know that there were some talks last year in this series about how insurance is important for the disadvantaged people. They are more subject to disasters and all that. And if you look around the world, insurance has a tremendous amount of potential in the microfinance field. Like, there are hundreds of millions of people, poor people in the world. Most of them are subsistence agriculture farmers. And they're vulnerable to financial shocks, droughts, locust disease, various things. And they're just barely making it anyway. And so when they get this kind of shock, it forces them to sell essential capital like their animals or their land. So they enter poverty that could be, could be literally life-threatening. I mean, it could be the end of their or their children's lives. They're that close to the edge there. And NGOs like the CARE and World Vision spend a lot of time encouraging savings groups among these subsistence farmers, which act as mutual insurance companies. In other words, when things are okay, these poor people are able to pay small amounts into these savings groups, and they get interest for it, which is they appreciate. But they also, if and when a shock actually occurs, they have a fallback. Then they have a way to get themselves through that without having to sell their means of livelihood, and they stay out of the absolutely life-threatening poverty that they're always just a step away from. And that could be expanded. That could be expanded. So insurance has a protective power, a valuable protective financial power that's not even been fully realized. So on one hand, I think there should be more insurance. But on the other hand, I think there should be less insurance, especially in the developed world, much less of it. I mean, if it's really hundreds of billions of dollars spent on just extended warranties alone, let alone low deductibles and pet insurance and all this other stuff, it's a major non-productive use of resources, right? And, as history has shown, insurance needs to be regulated. You can't let insurance just go wild. And I was telling Peter earlier, I was just fascinated by Jeff Clark's talk last year about the history of insurance. It shows in the early days before regulation, it was just wild. People would insure each other, insure each other's lives, and people would buy insurance against getting sexually transmitted diseases. I mean, it was so calling out for regulation. And of course it did have regulation in the latter part of the 1700s. There was something called the Gambling Act in Britain that started regulation of insurance. Interesting name, gambling law, because insurance was widely considered gambling, and they wanted to distinguish it from that. But I think that there's still some gambling sense left in insurance. And so, the regulation should be sharpened, to create less insurance. So, for example, and it's just offhand, two suggestions of regulatory thrusts for insurance. One is to make high deductibles the default by regulation. So if people want lower deductibles, they have to show need. They have to provide some means to show that they really couldn't cover $1,000 loss, a $1,000 loss, and that's why they need $500 deductible on their homeowners insurance policy. It shouldn't be. They should have a high deductible level as the default. And the second is, the people are very, very, we have a obesity crisis. People are very health related, nutrition interested. They think it's very important to have disclosure on the nutritional values of the food we eat. So the Food and Nutrition Labeling Act of 1990, I believe, was required that there are nutrition facts panels on all packaged foods sold in the United States, where they say the calories and the fat and the sodium and all of this stuff, right? It was disclosures on food, so that people can make better choices, right? Well, why not put that disclosures on insurance products, including extended warranties and deductible levels and all the prices of deductible levels and so on, so that people know how much they're really paying for it. That would be pure direct loss ratios. In other words, what percentage of the dollar they're spending on it do policyholders actually get back, actually ever see? There should be, that wouldn't cripple the insurance industry to require that. It's something that's easily available to them, and it could be, and it could make a big difference in people's likelihood of buying insurance or different insurance products or deductible levels on their other insurance products. So perhaps, more than any of the other innumerable consumer products that we study, the success of the insurance product is based on regulation and law. And so in that regard, I feel, I think I can speak for Matt too, feel very privileged to have been able to share our research and our views on insurance in this distinguished law school setting. So thank you. And I'm open to comments here.
Wonderful. Thank you very much. And let me just say that, like any good paper or presentation, it raises as many questions as it answers or more. So let me just start off by asking you a couple of things that occurred to me, and then there's a queue already of people who have their hands up. So what do you think if you asked people directly, would they tell you, yeah, you know what, when I buy insurance, I think I'm actually lowering the probability. Just my act of purchasing it would lower the probability that I'm going to get into a car accident or lose my, stereo headphones or whatever it is. And what would it mean if they said no, given that, my guess is they would say no. I don't think people actually literally believe if you ask them directly, hey, do I lower the chance that my headphones are going to break by buying insurance? So then the follow-up is if insurance is reducing anxiety, people do a lot of things to reduce anxiety, including taking medications that are, some of which are prescribed, some of which are over the counter, and some of which are bad for you. If I'm really getting peace of mind by buying insurance, and it so happens that the way I get the peace of mind is I rationalize to myself saying, oh, look, if I get this, I don't have to think so much about a loss. And so then I'm going to underestimate the probability that a loss will occur. And I'm going to sort of, in some sense, attribute that wrongly to insurance. But you know what? I feel better. I don't have to worry as much. Why shouldn't we want them to do that? What's bad about that? Rob, I think you're muted, or at least I can't hear you.
Thank you. Those are two questions. So should I take them one at a time? Or Matt, do you want to take one? Or okay. The first is, no, people, I think your intuition is right. I don't think people would be able to say that insurance lowers the probability that the event will occur. I don't think people have that. It's a feeling. I don't think people are very good at all at introspecting about their feelings. I have a course that I teach about, I call it head-heart balance in the workplace. And one of the things is we talk about how, how feelings need to be integrated into your managing yourselves and managing the other people in an organization. And we have these exercises where people have to introspect on what they feel. And it's incredible about how hard it is for people to do it. We have some easy examples. We ask people sometimes to, we play a song. We have a little graph where you can move a cursor to indicate how you feel during each part of the song, so you know what part you like better and what part you don't. Some students have a lot of trouble with that. They go higher on the louder parts. They go lower on the softer parts. One student, when he chose the song "Stairway to Heaven" and he made his graph look like a little stairway. He couldn't just think about how much he liked each part of the song. They panicked there. They said, I don't know how to do that. I gotta have some kind of trick. I don't know what people don't have very good access to their feelings. So no, I don't think that people would anywhere begin to be able to estimate, to intuit or introspect on the ability of insurance to make them feel better about a product, at least not in a differentially, what's the probability with insurance, what's the probability without insurance. I don't think they would. And the people who would answer that would answer what they would think that should be. They would choose the logical answer, like there should not be, once they understood the question, they would not show the effect, I believe. So that's the answer to the first. And that was your intuition, right, Peter? Yeah. Are you muted too? Yeah. Okay.
Yeah,
Right.
I'm back.
And then the second is, well, why is that bad? If they want to use insurance to, if we let them know that this occurs, and we say, part of the reason you buy insurance is this, is that bad? And I would say, again, I think you can predict what I would say. As long as they know how much they're paying for that, that's okay. If they know that there is evidence that this illusion is part of the reason they're choosing insurance, it's an illusion, but it's part of the reason they're choosing it. And here's what they're paying for it. This is the loss ratio of this insurance product. If they still want to do it, fine.
Okay, great. So we have a queue so far that consists of Autumn Siegel, Andrea Martin, and Bob Yass. But if you want to, I can't see everybody on my screen, unfortunately. So it would be, I think, more effective if you send me a chat. But Autumn, you're up next. You have a question.
Thank you. So I had two questions. One of the last things you said in conclusions was about that insurance should have a higher deductible, and I just was wondering if you could make that connection a little bit clearer. Is that just to avoid people buying products which aren't as useful to them, like pet insurance and things like that? And my second question was, how do you know that you're not just measuring the segment of the population that's naturally more risk averse?
Well, I don't understand the second part, but the first part is uh, low deductibles are you pay higher premiums for low deductibles, right? If you're insuring your house for your $500,000 house for fire damage, destruction, right? And you have a $500 deductible. If an awning blows off and it causes $1,000 loss, you'll get $500 back from the insurance company. Now you didn't need that protection. You could have repaired the awning for $1,000. You didn't need that. You didn't need that $500 you got back, but you paid for it. You paid for that protection. Now, if you say, "Oh no, I'm going to have a deductible level of $5,000," say, your premium is going to go way down. Because if you have a loss of $1,000 or $2,000, you'll just pay for it. It's only if the whole house burns down that you get your $495,000 back, right? That's the insurance you need. You don't need insurance against a tree falling on your porch or awning blowing off. You don't need that protection, so you shouldn't have to pay for it, especially pay for it where you're only getting probably less than 60% on your dollar. That's pretty expensive. So that's the deductible part. Now the other part of your question I didn't quite get.
Autumn, you want to come back, or go ahead?
Go ahead to the next person, I guess.
Actually, I think, Autumn, I think I understood the question, so maybe I can help with that one, Robert. It sounds like you were asking, could the effect be driven by, in our sample of participants in our studies, were we just somehow managing to only get risk-averse participants? And so in most of our studies, we're using a national sample, and we're relying on experimental design and randomization. So in our studies, we might have participants assigned to one condition where they are given information about the insurance, and in the other case, they're not, and then they're asked the same question. So because of the power of randomization, we don't think it's likely that the effects are driven by individual differences in the participants.
But I understood Autumn's question to be somewhat different. That is to say, how does personality and especially risk aversion interact with the talisman effect? Is it something that maps to? Because I mean, you guys had a lot of stuff that you asked about, but you didn't try to do any studies, you didn't try to get at individual risk tolerance behavior, and there's tons of instruments that try to do that. Is the talisman effect orthogonal to that? Is it the same as that? Is it correlated with that? Like that's what I understood your question to be. Do you have any thoughts about that? I know it wasn't in your study, but any intuitions?
Yeah, Robert, do you want me to take that?
My intuition would be that the more the person who is more fearful, maybe more, you could say more risk averse, would show a bigger effect. And actually, it was in an earlier study that we did where we measured superstitiousness, actually. And we didn't publish that for various reasons, but we measured superstitiousness, and we found that superstitious people who rated high on a superstitiousness scale showed more of that talisman effect than the people who weren't superstitious. But that was also superstitiousness correlates with emotionality too. So that suggests, and that might correlate with risk aversion, fear of taking a risk. So then the answer, I guess I would guess probably yes. There would be, people who fear risk more would be more susceptible to the talisman effect, I would expect.
It would be interesting to try to find out. All right, Andrea.
Hi, thank you for being here with us. I was just wondering, is a consumer's awareness of the potential for the talisman effect likely to influence their purchasing decisions when it comes to maybe purchasing insurance or deciding whether to get it at all?
Well, again, I think we would again say that most people are not aware of this effect. But if you were to be made aware of that, and then you had to try to compensate for it, even though people wouldn't introspect it, they would say, well, maybe they wouldn't be able to introspect that they're doing it. And so now they're asking to compensate for something that they're not aware that they're doing. I don't think that would have a big effect on their behavior. But on the other hand, if they were just clear on the concept of insurance, that all they're getting, is money. They're not getting, they're not going to make the situation right. They're not going to prevent the car from crashing or the house from burning. It's not going to, or the person from dying or anything like that. It's only they're going to get a lump of money. That's it. And that's it. That's all they're going to do. They're going to get a lump of money. And that the company that's offering them, taking their money and going to offer them a lump of money is making 40 cents on the dollar. If you tell them that, I think, if they really understand that all they're getting is money, and that the company that's giving them, that deal is reaping 40 cents on the dollar, I think it would give a lot of people second thoughts about insurance if they really got that.
Great. So who's up next? Bob Yass, I have on the queue.
Thank you both for this presentation. I'm interested in your comments towards the end about public policy implications. And one that occurs to me, and I don't know whether you've studied it or considering it for a future study, is that anxiety issue, looking at it across different age groupings. When we think of kinds of insurance that may be marketed to older individuals, that may play off of that fear factor, that anxiety factor, and the messaging and the advertising for that, there may be some public policy implications by drawing that information out. I'm wondering if you've considered that.
That's a good idea. Suggests, I mean, you have something specific in mind, that older people are more fearful or less fearful? Or?
Well, I guess that's the sort of threshold question, right? Is that something that's out there? Intuitively, maybe yes. And certain kinds of insurance may play to those anxieties. And, daytime television is full of, guaranteed low limit, AKA burial insurance policy advertising. And it may go into the messaging. And if there is some sort of regulatory or public policy.
Is there burial insurance on daytime?
Well, not labeled as such.
Oh my God. That's interesting. So in other words, look for situations, there may be situations where it appears that sellers of insurance are intuiting that here's where the special fears of these catastrophes might, these perils might be present, and therefore they're offering insurance for them.
Well, and the advertising message very often is your guaranteed acceptance for fill in the blank dollar amount per month, without mentioning what kind of limits of insurance you get in return for that premium. That's the marketing, but the preliminary message is that you need this coverage to cover funeral costs or other unanticipated costs of death.
Yeah, that sounds like a good idea. Worthwhile to investigate, I would say.
Excellent. All right, so Travis, you're next, and that's all I have on the queue at the moment. So anybody else is welcome to come in. I got a million more questions, so you don't have to. But
yeah, great. So thanks for joining us in a fascinating paper. So I'm not yet convinced, and here are two ways that that one might argue that the talisman effect and the gambling effect are both entirely rational. So on the talisman effect, as I understood some of your example or some of your studies, we were contrasting what was it, like the when you go for a vacation and you loan your precious thing to someone, and in one case you just loan it, in the other case it comes with a 100% worry-free guarantee. I mean, it is the case that insurers require there to be loss mitigating or loss avoiding steps to be taken when they underwrite a thing. So like the fact that something has insurance suggests that the insurer has mandated that, for example, fire extinguishers be mounted to the wall or whatever. And so there's good reason to think that a loss is less likely to happen because an insurer has been in there and, you know, study the premises. So that's would seem to be one explanation for the talisman effect. On the gambling effect, I mean, if the idea is that, if the proposition is that people irrationally think that they are going to be gaining money by buying insurance, I mean, surely that is true if people are adversely selecting themselves into the pool, right? If they think that they know more about their risk profile than the insurer does, and they're getting a good deal because they're, you know, they're riskier than the insurer thinks they are. And so then, strictly speaking, they are more likely to make money from buying insurance. You know, and moral hazard is another way that could happen, right? Like they know that they're going to spike those headphones on the ground tomorrow, and the insurer doesn't. And so in a sense, they're going to make money there. So anyway, those would seem to me to be perfectly rational explanations for the types of behavior that you're studying.
Okay, well, I would think that they are things that are testable. I mean, the idea that if it's insured, will, you know, if if you know if you insure the life of your pet, what mitigating factors can the insurance company have done to make it less likely that that be hurt? You know, if there's, on our scenarios, it's not obvious that it's not clear that there would be, if you're going to be shipping something and it's either be insured. I guess they could have presumed that if insurance is available, the insurance company might have checked out the shipper. I don't know, Matt, but that's a possibility. But I would think that we could easily come up with situations where any kind of thought of that would be very implausible. Any kind of sense of insurer mitigation could be eliminated. I think so. I think that's a testable possibility. And the other one, the adverse selection, again, that has to be, I think Peter mentioned earlier, a field study or something like that. Where we would, we could sort of show that people who, I mean, it's possible that the people who buy the insurance really are going to have more of the I guess, I guess there could be firmer proof of that. But I guess, Travis, I think that the insurance company wouldn't be making money. They wouldn't be having, if that were the case, when they sell this product, this heavily advertised, this heavily promoted product, why would they sell it if the people who are going to buy it are going to be really careless with their headphones or washing machine or something like that, or just the people, it wouldn't make money for them. Maybe that's the answer.
Right. I mean,
how could it make money if there was adverse selection
so
or
just to
moral
follow
hazard?
up on that, I mean, if that's true, then the mysterious thing would be, why do people irrationally think that they're always adversely selecting into a risk pool? And
Yeah,
that, I mean,
that's the effect. That's the effect, Travis.
right,
That's
but
the
that would seem
effect.
to be
People
then a
believe
different.
that they're special. They're special. No one else is as likely to break that headphone as I am. Right?
This is,
That's like when
I'll
right?
just plug now a video of a very interesting talk we had last year by Casper de Jong that's very topical to this point. And then I'll shut up.
I didn't get
Okay,
that. Yeah.
so we're running out of time. I wanted to maybe get one last one. Rob, would you be willing to stick around just a little bit afterwards?
Oh,
If people
sure,
have
absolutely.
wonderful. Okay,
Absolutely. I want to get Travis's other point though too. Also.
Yeah. So Jackie, you got the last word for the official proceedings, and then we will stick around if you want, or you're free to go. Jackie.
Thank you. Off of Professor Yoss's point about age, I was also curious if You might find, not to propose tons of more research for you to do, but if as you went, you would find that those who were lucky over time had a reinforced talisman effect, and you'd find it was very strong, that they just were lucky not to have anything happen to them over time, and they now thoroughly believe that insurance really proved that. Or on the other hand, if this effect exists as you go and have people who happen to have as many bad things happen to them as should, or even more claims they have to pursue with their insurer, do they get jaded, and does that dispel this belief that insurance should prevent me from having future harms?
Interesting. Well, of course, most people don't have claims, don't have disasters, don't have claims. So for most people, the world would seem to show that insurance works.
Right. So
Keep the
theoretically,
bad stuff away.
the longer it works, right? Yeah. Thank you for presenting as well.
That's the quick answer, I guess. But the question you raise is really interesting. I gets me thinking of maybe a way of testing. There might be a way to particularly test that, to manipulate that and test it. That's a good point.
Awesome. Thank you all so much. Those who want to stick around are free to do so to continue the conversation. If you need to go, you're excused, at least until 2 weeks from now when we'll have a next speaker. Thanks for coming, everybody.
Thank you so much, all of you.
And thanks especially to Rob and Matt for showing up. So we had a bunch of people who wanted to get in. Linda, are you still here? I don't know if she had to leave.
I am. Thank you.
Oh, great.
And I come from the regulatory community. So I was picking up on the comments on the 60% pure loss ratio, which seems to me that that must be indemnity dollars only that are paid to claimants after a loss, and would not pick up on things that are essential to the doing of the insurance business, such as allocated loss expense, unallocated loss expense, administrative expense, commissions to producers, et cetera. So could you clarify a little further on the 60% loss ratio? Thank you.
Yeah, well, to me, from the consumer, I understand that the gross profit is just that. It's very gross. I think of the 60% loss ratio, meaning that the company gets 40% gross profit. Now, I understand a lot of essential things come out of the gross profit, right? So it's not their net profit by any means. So I'm not faulting them for making too much money on insurance. Really, what I'm saying is that number is important from the consumer's viewpoint. That's their expected return on their insurance dollar. That's my point. So do you still have a question given that explanation?
No, I understand your explanation.
Okay.
But in terms of disclosure, you might want them to know, well, how much of that is actual profit, because
that's the point. No, it's not a matter of denying the insurer profit. It's a matter of telling the customer his expected return on the dollar. That's the key thing. It's not a matter of judging how much profit the insurance company should make. And that's maybe why people have resisted that, because they're afraid of that. I wouldn't support that. I think the disclosure should be what was the expected return on the dollar for the customer. And that is so important. And being 60% makes it lower than gambling. Most states, the gambling regulatory agency caps the take of the casinos and the slot machines at 20%, not 40%. And in New Jersey, you can go to Atlantic City and play the slots all day, and you're going to get back 83% of the money you put in your slots. That's a lot better than insurance, and people should know that.
Okay, Frank, you were next. I'm sorry, I didn't get to you before.
I'm wondering whether
I can barely hear you.
can you hear me now?
Yeah.
I'm wondering whether your findings explain something that I have noticed. I know a lot of renters who do not carry renter's insurance, which means they have no personal liability insurance. So if they leave a skateboard out and someone trips, they don't have any coverage. I know a lot of people with substantial assets that do not have umbrella insurance, which would protect all of their assets from judgment, and also give them personal injury coverage against things like defamation. These coverages are relatively inexpensive, and it seems like they would buy a lot of peace of mind. But I know a lot of smart people that don't have these things.
It's a good point. I suspect, I don't know what percentage of people don't. Everybody I know has that, who have resources, who have assets, have umbrella policies. But I'm sure there's some who don't, and that's a totally different kind of issue. That's where insurance really is needed, and they don't, for one reason or another, have it.
And young people who rent apartments, they don't have a lot of them. It might be a cost factor, but they're bare with they commit negligence. It's not via automobile.
Is Jay Feynman still here? Jay, still here? He was here. Jay Feynman has done some work on the insurance gap. He has a conference, periodic conference on the insurance gap for questions like these. And one of the things that he's told me is that courts will generally not grant big claims liability claims against people who don't have the resources to pay those claims. So that's, sort of undercutting the need for that kind of insurance. I don't know the real balance of that, but that's something to look at. If in the issue of, is there really an insurance gap there? Is there a need for more insurance there, or is it muted by the idea that the court's are going to be reasonable and not put someone into debtor's prison because he left his skateboard out and someone got hurt from it?
I would also add that part of that might also be driven by communication issues, right? Like, I think for many people, these various types of insurance are still overly complicated for them, even if they are educated, right? Or they may not want to spend their time thinking about it. Oftentimes, thinking about insurance means thinking about the prospect of something bad happening that you don't necessarily want to be in the forefront of your mind. So those all could also factor in for why people don't take these kinds of products.
Thank you.
Okay, so I had Peter Kotchenberger, who's waiting somewhere. I can't see you, but I think you're still here. And then Marcos Mendoza.
No, I am. Thank you, Peter. And thank you very much. The studies are interesting. I appreciate you taking the time to talk with us about them. I guess I may not have understood. I don't know if I heard or understood correctly, but I have to say I'm skeptical of the argument that the general problem is people buy too much insurance. And the reason for that is not based on studies by insurance companies, which have some validity, but also the motive. But pretty much, I mean, all the problems.
I lost you.
Peter, you're muted now.
Yeah, the problems we see is under insurance, right? I mean, or the lack of flood insurance, houses not being valued, whether in a natural disaster or at any time, houses not being valued sufficiently to pay for the actual rebuilding costs, or not being updated for the ordinances. And I know, and this is done, I think, international studies as well as not simply in the United States, that one of maybe the best or biggest predictor of whether a region recovers from a natural disaster is the amount of private insurance available to rebuild. Liability insurance, you mentioned those are some other examples. And I guess the other point is, to the extent that taking evidence and I, again, may have misheard, evidence from extended warranty contracts. I mean, I agree with that. That's a lot of names for that. One is sort of schlock insurance, but that's whether that's even insurance is they contest sometimes. But I don't think that is indicative of the insurance issues and products. That's a very much of a fringe product. More like credit insurance in the sense of its value is dubious and its cost grossly grossly expensive. But generally, I think the problems, and that's, I guess, the question. The problem is that we see more people not having sufficient insurance, and never mind life insurance and retirement benefits. But what do you, is that, I mean, so that's, I wanted to ask what you thought about that. Thank you.
Well, yeah, there are, see, the problem, I think that the problem, I don't get too concerned about not having enough insurance, because what I've seen and I don't have data on it, but what I've seen is that when like a disaster hits, hurricane or a flood, and there's a lot of people who were not insured for those things, which are very expensive to insure against, the government comes in and bails them out. So in a
That's
sense,
interesting. That's
yeah.
the perception, but they actually don't. I mean, they don't rebuild the homes. They put them in FEMA trailers for a month or two. But I'm sorry, I didn't mean to interrupt.
Yeah, well, I mean that uh, uh, that would be FEMA trailer for a couple of months, and then then your house gets built again. I don't know. It doesn't. It seems to me that the government has undercut the motivation for insurance. I mean, if the government had not didn't have programs like that, and people were really hurting without insurance, that would drive both the industry and the consumers to have that insurance. But it's because of the bleeding hearts in the government. I mean, or not. I don't want to be negative about it. The caring people in the government have undercut some of the motivation that both people and companies would have to offer that insurance. It's going to be expensive, but ideally, in an ideal situation, private insurance should do it, not the government, I would think.
I mean, I'm
And to
happy.
me,
I don't want to take
the
any time.
argument for more insurance comes where there's no government bailout, like in the Sahel, like in the poorest parts of Latin America, where people who don't have insurance die. That's a different matter. That's why I
Right.
brought up that. So
Well,
I think there are
Louisiana,
situations where
right?
there
I
should
mean,
be more insurance, but they're not much in the developed world, not much in the U.S. Most of the U.S. it should be less insurance, much less.
I think much of New Orleans isn't rebuilt. And that has a lot more to do with insurance because FEMA doesn't come in and rebuild neighborhoods. They temporarily feed people, but they don't have programs, at least absent extraordinary things, I think, to rebuild a permanent home other than a separate program. But I agree that can be a perception. But anyway, I've taken, this is
Interesting.
fascinating.
Yeah, interesting.
Great. So
thought.
let's go to Marcos, and then at 5:15, I think we kind of need to draw a halt to the proceedings. So Marcos, you got the last one.
Yeah, my question was what Peter was getting at in the last part of his comment. So as your point number two, when you talk about making money and gambling as a reason, is warranty research really helpful to insurance? I mean, in my way of looking at it, warranty coverage has to do with covering a aging property, but that insurance, it's about a fortuitous event. They can overlap sometimes, and as Peter pointed out, that insurance regulation can sometimes get confused as to the boundaries there. But is that warranty research really transferable to insurance?
That's a great question. It's a great question. And I think the reason it's a good question is because uh, you have a point in that extended warranty is not called insurance. It's called extended warranty. It's called something else. So that's in the right direction, actually. I mean, that we think of it as something. It is insurance, but if we don't sell it as insurance, that's a step in the right direction. And I would like to see, the other serious, overuse of insurance go in that same direction. I would like to see they separate, property insurance to the high loss and the low loss part and call it different names. In other words, don't sell homeowners insurance with a deductible lower than $5,000. Okay, because most people can cover that they have $5,000 damage on their house. While most homeowners policies have a deductible of $500, make it so that homeowners insurance has a deductible of $5,000. Now, if you want that coverage between $500 and $5,000, you buy another product that has another name, but don't call it insurance because it's it's different than, as you point out, it's different than the fact the need to have your house rebuilt. So yeah, I think you have a point there.
There's great work by Justin Sidner, who gave a talk here last year about the over purchase of low deductibles and why people seem to like low deductible insurance. Although he points out that the equilibrium, if you're trying to sort of game this out is that a lot of what those deductibles do is screen the higher risks from the lower risks. And so if you didn't allow low deductibles, you would have more pooling and you would have other kinds of problems. So it turns out to be not such a straightforward question to answer about what's the right level of deductibles to require, if any. It's a very complicated matter. But he certainly agrees with you that people seem to be buying deductibles that you'd have to be so extraordinarily risk averse as a rational actor to buy them that you should never get out of bed in the morning if that's really the choice that you make. Well, listen, I want to thank you guys both very much for coming, for a really great paper and an interesting series of talks and questions. And I think it's really a tribute to you that we had so broad participation. A lot of times the talks end and people go, that was interesting, I don't know what to say. And this is like, wow, everybody wants to jump in and raise a question or comment or something like that. So that was just really great. Thank you both for showing up for an interesting paper, and keep in touch. Send me your next paper and we'll see if we can get you back or something like that.
Sounds good. Thank you so much. And thank you for the questions, people. Enjoy.
Okay.
Yeah.
See ya. Bye, everybody. See you in 2 weeks.
Bye-bye.